All right, thanks a lot, Adam, for giving me this opportunity. Let us talk a little bit about three blocks and a little bit about real estate. And as you guys already learned more about DeFi and blockchain, so that is a good part that Alex and Paul give me a cue for that. So we can continue talk a little bit more about blockchain and real estate. So what is three blocks? Three blocks is a company who bring real estate onto the blockchain. So I'm presenting why real estate should be on the blockchain. So let's understand a little bit more about the problem statements, right? So currently the real estate, even though real estate is what 1,000, 2,000 year old asset class, maybe more than that, it is still clunky. We are not able to do it frictionless transactions. We still have multiple touch points: realtor, buyer, seller, government offices, agencies, municipalities, title offices. So there are 10, 15 touch points happening for one transaction, and that is costly and it takes a lot of time. If somebody wants to invest from Canada or Germany into American real estate or vice versa, just forget it. It takes 3, 4, 5 months. And then insights, lack of data. There is not enough data available on real estate and how it is traded and what is the actual price. It's mainly the buyer and seller deciding on the price, and then there are not much data points available to the buyer in most of the world, except few countries have developed sophisticated data structures. And liquidity itself, real estate is immovable asset, and it is hard to move real estate in days, right? So even if I want to sell my house, it takes at least 15 days to a month, so it is illiquid. So these are four problems, and then there are more to it, but these are highlighted problems. So what we are proposing, one is tokenization, and then a decentralized finance and personal decision making. So many of you have heard real estate syndications. People come in and pool money to buy a real estate. That's called syndication, and this happens in traditional world, and it takes around a couple of months to close a deal. Similarly, simple real estate, if you want to buy and sell, it takes a couple of months too. So, but tokenization, what it does is it puts a real estate into a limited liability company, and then the company is represented on the blockchain. So currently, there are no legal structure to represent real estate itself on the blockchain. So a lot of companies like three blocks, we have come up with a workaround where we can convert a real estate, put a real estate into limited liability company and represent that limited liability company on the blockchain as a token. So it is an intermittent solution, but this is not the final solution. Final solution will be when we directly put real estate address like 4000 Tampa Street. If I want to put that on the blockchain, I should be able to do it without having the limited liability company or without having any intermediate person in between. So that is the next logical step, but with the lack of legal structure, we are not able to do it today. So what we can do today is we can put a real estate in a limited liability company and then represent that limited liability company on the blockchain. So that's called tokenization, asset tokenization. For example, we can put a car or we can put a watch, we can put any asset onto the blockchain, provided we have some sort of custodian holding that asset, and then responsible to make sure that asset is legal, legit, and then it is not a scammy, and then it's not a Ponzi scheme. So tokenization brings real estate onto the blockchain. And DeFi loans, as I said earlier, it takes time for anyone to acquire a loan, go to bank, and then present a million documents, and then present your own credit score and all. Go to 5, 6 banks, and then it takes weeks, 2 weeks, 3 weeks to get all the documents together, and that is a tedious problem, and we are solving it through decentralized finance loans. We will get into the loans part in the further slides. And the third one is personalization, right? So the real estate, if I'm talking purely about syndication, if 10, 15 people are involved in one hotel or one multifamily apartments where everybody invested, let us say $1 million, and it's a $20 million asset. So in current structure, current syndication, that personalization does not exist. If I want to sell my share, I have to talk to every one of them and come to an agreement. I have to find uh, a buyer, and then operator, we call them operator, has to approve it, and board have to approve it. So there is too many human intervention in current syndication process. But on blockchain, since it's a token, since it's in your personal wallet, I have a full freedom whether to sell it, or whether I want to take a loan against it, or whether I want to vote for any of the changes in the apartment. If I want to, somebody says put a dog park, and then out of 20 people, 10 people can vote on the blockchain without having to talk to anyone, without having to getting to any conference call or anything, whether they want to have a dog park in apartment community or not. So this token represents the ownership right, and it comes with a voting right, and you can do whatever with it. You can take a loan against your own fraction of the real estate, or you can sell it, or you can vote on any of the changes that you want to see in the apartment complex. So that power you cannot get in the traditional financial system, traditional real estate syndications. So that blockchain is, we are able to do it in a blockchain only because everyone is sharing the same database, be it be a lender, be it be a borrower, be it be a voting protocol, any protocol that we build on a blockchain. Let us say for Ethereum, every protocol that we are building has access to the same data, same token, and if I am making a decision, that is visible to all the nodes and all the people around the world, and indirectly I have full control over my ownership in a real estate. So benefits of tokenization, we briefly touched in previous slide. One is increased efficiency, fast. You can take a loan in 2-3 minutes and then buy a house on the blockchain under 10 minutes. And we have done 100x improvement, or maybe 1000x improvement from the traditional system, where traditionally if you want to buy a fraction of a house or a house, and you are sitting in Canada and buy something in Miami, it takes 3 to 6 months. We have reduced it under 10 minutes. So efficiency is increased by 100 plus X. And then financial analysis, any whatever we are trading, blockchain trading data is open to all. So hundreds of people bidding against a real estate, it's open to all. They can see what is being the bid, and it is not private, and it is not like realtor taking 10 different phone calls and deciding, hey, he's saying 600,000, somebody saying 500,000, and you do not have full visibility what is happening when the trading happens, right? If somebody wants to trade Amazon stock on the Robinhood, I know what is the ask for that stock. But if I want to buy a real estate, I don't know who else is asking at what price. So that kind of data is not available in traditional world, but blockchain brings that through the trading desk. You can trade your own fraction at any price you want. It's a buyer who will decide whether they want to pay for it or not. And then customer experience is pretty neat. So a lot of the time in traditional world, we'll have to talk to hundreds of different agencies to make one transaction. Here it is one company, that is three blocks, who is bringing real estate onto the blockchain. So we are the point of contact for all of the queries. So customer experience is pretty straightforward and pretty easy, and it's seamless. And innovation, we'll get into this innovation, lending, borrowing, trading. This has never happened in the traditional world, and there is a reason why it doesn't happen. For real estate, we are able to do it for Amazon stocks, derivatives, bonds, treasuries, and various other stuff, but not for real estate. And that is a simple question: why not? So nobody is able to do it in traditional world because there are 100 other participating agencies, and nobody is able to represent it in a digital format. And that's one of the greater innovation what blockchain has given to us in terms of real estate. So how we are implementing through tokenization, which we spoke briefly, and this is one of our NFTs. You guys have heard million times about NFTs, and give me some claps if you heard NFTs, right? So NFT is mainly used as images, but the one of the best use case we think is a real estate. We use dynamic NFTs. Anytime there is a change to a real estate, our NFT changes. For example, currently it is 3 bedroom, 3 bath. Over the time, we add one more bedroom. So our NFT is dynamic and it changes in the back end. The NFT changes to 4 bedroom and 3 bath, and then the value of that asset is appraised by various other nodes that are involved. Mainly in traditional world, we have appraisers. Similarly, in blockchain world, we will have real estate appraisers with their own nodes, where they can appraise the real estate and then give a base value based on the dynamic NFT changes. So, implementation plan, we have, let us talk about DeFi loans first and then go back to the GPLP position. So earlier, Alex spoke a little bit about the over collateralized loans. And in traditional word, we have under collateralized loans in most cases. But is that really? That's the question we need to ask. When I take a mortgage, is that under collateralized? I don't think so, because I am paying 20% of the house price, and then the first lien on the house is bank, so they get the house. So technically, it's a 120% collateralized loan. It is not 20% min, 20% collateralized, right? So it is 120%. If something goes wrong, if I don't pay, bank gets to keep the house as well as my first initial 20%. So it is over collateralized in a sense. And also, if you take 5 10,000 personal loans, you are collateralizing your own personal credibility, your credit score. That is much bigger than a lot of other collaterals that you can bring to the table. If you're not credible or credit worthy, you might not get any financial inclusion in the future. So in traditional word also, it's over collateralized, but in a way that we do not understand, because it's business as usual. Uh, in in crypto, we mainly have over collateralized loans, and that's what we are using for our 3 blocks platform. How it works? So for anybody who has a Bitcoin, earlier there was a question: if I have $10,000, why would I need to take a loan, right? So if I have a Bitcoin, let us say $1 million worth Bitcoin, the idea is not to sell Bitcoin, definitely to have the upside potential of Bitcoin. And secondly, if you sell a Bitcoin, it's a taxable event. So if it's a taxable event, we have 20% to 40% depending on the geography. Why would anybody would like to pay 20 40% of taxes uh, on top of your other taxes, right? So I'm not against the taxes. It's just all the rich people, intelligent people, they pay less taxes because they use their assets in such a way that they leverage it. When Elon Musk bought Twitter, he did not sold all of his assets and bought that $45 billion. He technically leveraged every other asset that he had: SpaceX or Tesla shares, SpaceX shares, his personal real estate, various other assets, and also some venture capital. So that's how he bought Twitter. So why not we can do it, right? As individuals in traditional finance, it is not possible. I might have $20,000 worth Amazon stock, $20,000 worth Facebook stock, and I want to buy a house. I still have to go and find that 20% from my bank account. I am not able to leverage my existing financial assets. So that's not fair system for a small people, or middle class or lower middle class individuals who have assets but they cannot leverage, or they do not have knowledge how to do it. But in crypto, that barrier is broken. If you have Bitcoin, if you have Ethereum, even if you have any other asset, you can bring that as a collateral and then take a loan. Use that loan in our platform, at least in 3 blocks. Use that loan to buy real estate. So now you have increased your wealth without selling your other assets, and you are also earning the passive stable income in dollars from your rental properties, or it can be a hotel, or it can be Airbnb, or it can be multifamily. Wherever you are investing, it is bringing the passive rental income, and that rental income can be used to pay towards the loan. If you are taking loan at 6-7%, and if your asset is bringing 10% annually, so you are still making 3% cash on cash return, and all of your assets are safe, and you are making your wealth grow. And that's the best use case I have seen in blockchain so far. One of the best, I would say. So let's go to the next one. So earlier, I skipped over the second implementation plan. That is where we are putting the real estate, right? Where we think real estate does well. At least in US, we know these are the markets where we want to focus on. The highlighted in blue: North Carolina, Tennessee, Florida, Georgia, Texas, and Arizona, and few other states, as you see on the page. And these are the real estate, these are sunshine states who have been historically doing really well for last 30-40 years. And yeah, definitely there were some issues in 2008, and obviously there will be some issues if there is a real estate correction. But these are the real estate markets which have historically done really well, and they are growing in terms of capital influx, in terms of human migration as well. A lot of people are moving out of Canada, out of northeast states like New York, New Jersey, and California, but coming into these states. So that's where our target market is for real estate. And how we operate: we work with bigger real estate companies who already have 1 billion or 500 million assets under uh, management, and then they usually provide 15, 20, 18% of IRR, that is internal rate of returns. And then they are well known industry leaders in terms of multifamily or hotel real estate investments. So we work with them. We take a co-general partner role. We work with thousands of investors around the world. They can invest in these real estate fractionally, which earlier they could not. Now, through 3 blocks, they can take a position in these multifamily or these hotels from their living room. And that's how we identify our best performing assets, by working with best performing, historically best for performing real estate companies. So let me go. So these are some of the key sponsor characteristics which we talked earlier. Okay, so mainly why we want to have real estate on the blockchain. This is the conclusion I think makes more sense to you after listening to previous slides. One is increasing the liquidity, lower transaction cost. As earlier Paul said, we should not be paying 6% fees for moving bytes of data on the internet. It should be much less than that. When we are moving technologically from paper to digital version, fees should go down, not high. And then transparency is what we bring to the table through blockchain. And then leverage real estate. This is the most important thing: leverage, 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 but do it. Do it efficiently. Don't We don't recommend doing 100x leverage, 20x leverage, 50x leverage. And again, it's not a financial advice at all. It is just what we have seen historically rich people do, what we have seen rich real estate gurus do. They leverage efficiently, and that's what we bring on the blockchain. So we work with various other DeFi companies so that people can leverage their Bitcoin, Ethereum, etc., and buy real estate and have that passive income.